Welcome everyone to Can You Believe It's Already March webinar and strategy update. I know I realize I say that every other month, but it's amazing how fast this year seems to be going. My name is Keith Duran. I'm the Senior VP of Business Development, and we're joined, as always, by Jim Warner, who is the Head of Research and Co-Portfolio Manager. For those that are new to us this month, obviously, and as in the name, these webinars are not just to provide, economic and market information just for the sake of a data dump, but rather how does this data, the markets, the economy affect what we own and how we dynamically manage that risk in our strategies. And it's our own creative research that derive these irrefutable themes with long-term secular tailwinds. So if you understand the themes, AI, fifth industrial technological revolution, electrification, power, natural gas, biotech, et cetera, then you understand why, and your clients understand why we own Microsoft or Apple or Eaton or gold or uranium and so forth and so on. And then lastly, because we believe in the law of diminishing returns, these portfolios have a maximum of only 30 securities. Which allows us to maximize returns and minimize risk, but it also makes it very easy for your clients to understand what they own and why they own it when they look at their statements. So before we begin, the last thing I would just encourage you to ask questions. You can use the Q&A button at the bottom of the screen. Go ahead and type those out, and then at the end of Jim's prepared remarks, we'll gather those and then answer them at that time. So without further delay, Jim?
Great. Thanks, Keith. Thanks, everyone, for joining us today. Let me share my screen here, and we'll get underway. So this month's presentation is entitled Momentum Meltdown, and that's essentially what we've been experiencing for the last couple of weeks after a really big start to the year in January, February, which generally tends to be a seasonally weak month for the S&P overall, has certainly followed through on that promise. But there's a lot of competing narratives out there. So we want to basically talk about what's actually going on. And we'll touch on a bunch of things. And like Keith said, I certainly hope that you have questions for me at the end. But let me bang through a bunch of slides first and see where we come out. So what's really fascinating about what's going on is that investors are really scared. They're super scared. This happens to be a fun little dial that CNN puts together called the Fear and Greed Index. And basically, it is pinned in extreme fear. And you're like, why is this possibly the case? So, and if we look at another scenario, another survey, this is the American Association of Individual Investors, and there's a survey that basically evaluates the bearishness versus the bullishness. And this chart is basically, if you subtract the bears from the bulls, when you get a negative number, it means that there's overall bearish sentiment. You can see that essentially we're at near crisis levels. People were less bearish in the early days of the pandemic compared to where they are today. So incredibly bearish sentiment. Now, one of the things that this is being blamed on is what I'll call the quote unquote growth scare. Well, there's more to it, but here's some of the individual data points, right? We all know about tariffs, so tariff uncertainty. What's the impact going to be to supply chains and to prices? And I think where the market essentially is today is that inflation will be higher because of tariffs. Now, we don't necessarily agree with that, but that's where the narrative is today. And the narrative is that the tariffs could lead to lower GDP growth. And that might be the case too, but we don't have any hard evidence. But we definitely believe that it is very hard for businesses to invest for growth when they don't know what the rules are. And that's really a real critical point that we'll keep touching on. But it's really difficult to know whether you should go build that factory or buy these, raw material inputs to make more widgets if you don't know, what the rules are, what the tariff will be. That sort of thing. The other obvious piece of uncertainty that's weighing on investor sentiment is Doge. For whatever reason, the Doge is being feared, whether it's the federal layoffs, That's creating uncertainty, certainly for the Northern Virginia and Southern Maryland economies. That's a major issue. And we don't know what the civilian impact is either. So this is going to hit potentially certain IT services contractors, for example, that service the government. So we don't know how far that will go. But obviously that's a negative, and it's creating uncertainty, and the market hates uncertainty. Inflation, it seems to be kind of a little sticky. Now, we disagree with this, and we've gone through this ad nauseum as to why. In particular, we see shelter prices coming down significantly, and in a straight line down to the right. And I'm going to show you some other inflation data points here in a minute that will argue our case. But basically, there's sort of the narrative out there that inflation is sticky. Certainly, tariffs aren't going to help that. And then lastly, and I think this is actually more important than even the first three, at least in terms of what has happened in the recent weeks and how the market has really moved, is the massive concentration that investors have in NVIDIA. And, essentially many investors hold way too much NVIDIA, and you might even extend that to the Mag 7. And so what you've really seen actually in the last, and we'll go through a couple slides here, is that investors are basically selling their big winners, and one of their biggest winners is NVIDIA. So we've seen a really big hits on momentum names like NVIDIA. The really crazy thing about that fear gauge is that the market isn't even down that much. If you look at where we sit today, and these numbers move around, daily, but basically the S&P 500 is only 5% off of its all-time high, and it's basically down like 1 or 2%. So that's not a terrible, terrible situation. I mean, it's sort of a disconnect, right? In terms of how people feel versus what the market's actually done. In fact, I just saw a data point today that said that since March of 2009, which was the bottom of the market during the global financial crisis, this drawdown that we're experiencing is the 30th time we've experienced a 5% or more drawdown in that period since basically March 2009. So, we've seen this before, right? We've always talked about how market could go down 5% for a whole variety of different reasons. The NASDAQ in this case has corrected 10%, which is bigger, right? And that's less frequent, but it happens. And what it really goes to show is that it takes very little bad news when you're at record highs for particularly crowded names to correct pretty significantly. And that's exactly what you've seen. You see the chart, and that's why you've seen the NASDAQ, the technology names, the momentum names, really react poorly in the last couple of weeks, is because everybody owned them. They were up a lot, and a little bit of bad news and a little bit of uncertainty sprinkled in, causes people to sell. And then that just sort of, cascades for a bit until people get tired of it and they want to buy it again. So the usual suspects here that we look at is the Magnificent Seven. That's that index is on the left here, and NVIDIA on the right. You can see that there's been this pretty significant rotation out of the Mag 7 year to date. Mag 7 is down 9%. I just mentioned that the S&P is only down about 1 to 2%. So Magnificent 7 is underperforming, and NVIDIA is now down about 14% year to date. So not even a very good quarter, which they just put up, a $2 billion beat, which is about what the market expected, but not even that could assuage investors. They basically use as an opportunity to hit the sell button. What we're seeing this year is that last year's leaders, as a result, are this year's relative losers. So I just went through and mentioned Magnificent 7 versus the rest. Another way to think about this is the non-Magnificent 7, the other 493, they're actually up on the year. So let's pause there for 1 second and say, wait a minute, you just said the market's worried about tariffs, the market's worried about Doge, and worried about inflation, but then why are the more cyclical names outperforming and even up this year versus the technology names that just have a lot less to do with those three factors? So what's very interesting is that this is setting up an opportunity, I think, to buy these technology names that have traded off. And I'll get into that in a minute, but that's sort of the really interesting thing, that we have this mismatch between a negative cyclical narrative and tech being sold off, right? That doesn't connect, at least in my world. Now, the other good news about this sell-off is that we have seen a rollover in interest rates, and this is good, obviously, for the economy as well as for markets. You know, for the markets, we always look at the real yield here on the 10-year on the right-hand side. You can see it's sort of coming down. That means a lower discount rate, means higher asset prices. So that's actually one of the good things that's happening, which means that this dip eventually is going to get bought. Now, there has been some negative, incrementally negative economic news. And as you know, we spent a lot of time sifting through the macro data to try to understand how much risk to take in portfolios. And what I can say is, generally speaking, things are getting a little weaker. Let me start here with the Citi Economic Surprise Index, which I've showed you guys before. And basically, this is a measure of whether the economic data is coming in better than consensus expectations or worse. And what you can see here is when the line goes down, it means that the data is coming in worse than expectations. And so we've been on this like multi-month trend recently where the data really has failed to meet up to its expectations. So that's generally not a good sign for markets. The other crazy number that's out there that you may have heard of is the Atlanta Fed GDP Now model. This is their way of taking real-time economic data as it comes out and interpreting that as to what the next quarter's GDP or the current quarter's GDP will turn out. What's amazing about this one is that the latest Atlanta Fed GDP model for 1Q 2025, the quarter we're in right now, is that GDP will actually shrink 2.8%. Now, and you can see them in the chart on the left. This is like a really dramatic, this is just a very, very dramatic forecast. And it's almost like the economy's falling off a cliff. So what's happening here? Well, there's one major thing happening, and is that we've seen a massive surge in imports. And it's essentially caused by two things. Number one, there are a lot of businesses that have surged their buying plans to purchase raw materials, components, etc. Now before tariffs are put on. And so you've seen this kind of big buildup in inventories over the course of the last couple of months. And so obviously, if you think back to your macroeconomics class, an increase in imports actually drags down GDP. And so that's basically what you're getting. The second thing that's happening is that there is this allegedly, and through a bunch of more anecdotal evidence that we can cite, there is a huge amount of gold that is returning to the United States from abroad. And again, we don't know if that's tariff fear driven or if there's something else going on, but basically that too created this import number to be really high. So I would look at this data and sort of caution and say, it's not as bad as what it looks. I don't believe we're headed right into a recession, things are falling off a cliff. But this is maybe a data point that you or your clients will see, and you're going to wonder what in the world's going on. But this is a really interesting aberrant data point. The other question we have to ask ourselves is the consumer getting tapped out? We saw a really pretty sizable erosion in consumer sentiment in February. You can see that in the graph on the left. And we went from 74, 72, and now down to 65. I don't like that trend, honestly. That's a pretty bad looking trend. On the right-hand side, personal consumption actually declined month over month for only the second time since the pandemic started. So this is, not that the world, that everything's falling apart, but these are certainly signs that, that the consumer might be taking a little pause. Maybe they too are, worried about egg prices or, concerned about where tariffs are going. But people are essentially worried about, having a job and getting laid off. There could be a lot of things going on, but there's something that we're keeping a very close eye on. And then lastly, I'll show you that the labor market also is just now starting to show some additional signs of softening. The unemployment claims, we'll get another batch out tomorrow morning, but you can start to see the federal workers that are getting laid off come into this number. So I would expect it to continue to increase. On the right, you can see that the U.S. Manufacturing PMI Employment Index, this is really manufacturing companies' intention to hire workers. Remember, this sort of an index that less than 50 means shrinking. So, the manufacturing employment situation is still, pretty bad. And it's been that way for, as you can see from the chart, for quite some time. But who knows? We could see additional contraction with the impact of tariffs. Again, tariffs that we don't fully know what's going to happen there, in light of the fact that even last night, the Commerce Secretary came out and said, all those tariffs we just announced, 24 hours ago. Well, maybe there'll be a deal, and we can take some of them off as soon as tomorrow. So who knows where this all goes, but you can already start to see some weakness in the data. Now, as far as what impact the tariffs could have, it's really interesting if you go into the Institute for Supply Management's report itself, and you look at some of the commentary from the actual survey respondents. It paints an interesting picture. So a chemical products company said, I'm not going to read all of this. You guys can read this on your own, but chemical products company said the tariff environment regarding products from Mexico and Canada has created uncertainty and volatility among our customers and increased our exposure to retaliatory measures from these countries. Transportation equipment providers said customers are pausing on new orders due to uncertainty related to tariffs. A machinery company said that incoming tariffs are causing our products to increase in price. Sweeping price increases are incoming from suppliers. So, there's a lot of concern amongst the manufacturers in particular about what these tariffs will do, and we just don't know what the answer is, but it's probably not good. And it's going back to, I think one of the real uncertainties, one of the real impacts that tariffs will have, whether is maybe more in sentiment and willingness to to invest in one's business when you don't know what the rules are, as I alluded to earlier. And then there's going to be the practical impact that we frankly don't have the answer to yet. And then the other thing that we have to watch really closely is the services sector. It's 75% of the economy. Remember, on these PMIs, anything below 50 means contraction. Anything above 50 means growth. But the growth looks like it's eroding a little bit. If you look at the S&P Global Services PMI, the chart on the left, it's declined now, 2 months in a row. Again, is that a trend? I don't know. But it's at 51, which is just above, shrinking. And notably, that particular PMI survey doesn't include government activities. The ISM survey on the right, we just actually got this data point this morning at 53.5. It's actually better than expected. And so you've seen sort of a little bit of I think an uptick in sentiment on this growth scare. But, nevertheless, this metric does include government services, and we haven't seen the impact yet of the layoffs from DOGE hit this number yet. So I would expect future numbers to be lower. Now, I put all this in the context of, yes, there is uncertainty. Nobody knows how these tariffs are going to work out. We're not sure what the impact of DOGE is going to be. All of that is fine. And we have to wait for data points to understand how this is really going to impact the economy. But I'll tell you that the way we think about inflation is, and this is a graph from Trueflation. I've shown this type of graph to you guys before, but basically it looks like inflation is falling off a cliff. And if you dig into this data a little bit further, it's really happening in the housing prices. And at 1.44%, which is this company's real-time view on inflation, clearly that's way below the Fed's 2% target. This, in my opinion, would provide the clearance or the cover for the Fed to cut rates more dramatically if all of the things that I just mentioned really start to roll over. If all those data points really start to weaken, then this data from Trueflation would suggest that the Fed has room to cut. And I've talked a bit, in the past about the Fed put. And I think it's real, and I think it may be something that could be in play in the next, number of months. So where do we sit in terms of the Fed itself and the market's expectations? Well, the market is starting to price in a few more cuts. If you remember, we entered this year with basically one cut um, assumed for all of 2025. Now we're at three cuts, and then they're sort of spaced, over, you can sort of see it from the graph. They're sort of spaced over this, June, June, September, December kind of meetings. And then I also put in here in the on the far right the Fed's own projection of 3.9%. So the market was kind of in line with that when we started the year, and now you can see that the market is now expecting perhaps a slightly slower economy and more rate cuts. If you put a gun to my head, I'd tell you that I think there's going to be more cuts than this. But we'll have to just wait and see. But this is an interesting metric. This is another one of the reasons why you've seen overall interest rates start to come off. So let's dig into portfolio strategy. So what do we do with all this? I mean, there's a lot of uncertainty. So what we did coming into this month and through really January, where we had a nice big rip in the market, is we de-risked strategies on the margin. In fact, as we came in this morning, I'll show you this on the next slide or two, but we came in with almost 10% cash in our global vigilance moderate portfolio. So we have been trimming. What were we doing? We were trimming our technology winners primarily. This helped us raise a lot of cash. We actually also got out of India, which is it's connected to effectively the kind of resurgence in growth in China. I think what's happening is you're seeing flows move out of India and back into China. So we got out of the way of that as well. So where we sit today is in our moderate and conservative strategies, broadly speaking. We have a lot of cash and a lot of short-term fixed income, which, when it looks like it's appropriate to start buying the dip, we'll start buying the dip. But of course, we're going to be very data dependent on that. We are, as we have been, we are definitely trying to avoid stocks that are going to be directly or indirectly exposed to tariffs. Right now it's just such a hot potato and nobody knows exactly what's going to happen that, there's no way we're going to, be involved in like a, GM or Ford, or any, trucking company or that sort of thing. Businesses that could really have dramatic impacts to them. So we've really tried to kind of steer our way into sectors that have much less direct impact from tariffs. The Doge related weakness is really interesting, and we view it as what I'll call attackable. So very often people get really concerned about really dumb things and they just don't actually, process what's really happening. In particular, what we're seeing is really violent pullbacks in a number of defense names. So, and we think they're completely unjustified. The reality is we have a Trump administration that wants peace through strength. They want to substantially increase the defense budget. Yes, there's waste, and Doge is attacking it. And in fact, they already have a list of contracts that they want to get rid of. And that's now, within the last week or so, been filtered out to a lot of defense contractors. But the reality is, you can find places in defense where the names have been carried out with all the rest of them, but they're not going to have any impact. And so we actually recently entered a name called Khaki, which is a software provider for the DoD and the national security agencies. And we think that this is a remarkably, great opportunity to buy an amazing stock at a very cheap price that has been unfairly painted with this Doge brush. So there's lots of opportunities like that in this market, and that's what we're spending a lot of our time on. But we're being very patient, and we're trying to find these really offsides and situations. I alluded to India, but we're not the one place that we're not. The two places we're not paying any attention really to is China and Europe. We're not chasing it. Europe actually has been very strong year to date, uh, but those economies are a mess. And I know it's cheap, but it's cheap for a reason. I think Europe is still a value trap. But we'll have to wait and see. But it's going to take, a lot more than a little, perking up in the stock prices to get us interested. We're definitely not chasing China. China is a decade-long restructuring process, and we're just, there's been a nice little rip in Alibaba and some of those other stocks in the K-Web, but that's not a sector that we're willing to chase at this point, or country. So this is maybe the most important point on the entire slide. We are staying patient because of this economic softening that we're seeing in the data. And if that happens and we see more of it, we will get more conservative. We will see, we're already pretty conservative in terms of the amount of cash that we have, but we'll get even more conservative and we'll shift more into fixed income and more into, preserving wealth as opposed to growing wealth mode. But in the meantime, I think we're going to see potentially a rotation back into technology. So if you stop and think about what's been happening, as I mentioned earlier on, the very popular tech names have really gotten oversold. And those same tech names have very little exposure to tariffs, very little exposure to Doge, if any. They're much less cyclical than, say, a bank or a manufacturing company. They typically, during tough times, tough economic times, tend to be the actual defensive trade. They tend to be the place where you want to be. So I think once this, selling gets out of the way, we may be there after this 10% pullback. I think that could be a really interesting buying opportunity. In fact, today even we are in the market buying several different technology names. Just sort of adding a little bit, adding to the dip. And I think that could be, that's going to be a really good trade here in the near term. Don't forget the Fed put, okay? If things start to really break down on the economic side, I do believe that this Fed will cut, and that actually will help prop up risk assets. So even if we see the economy soften further, that isn't necessarily a disaster for stocks, because the Fed will cut. So that's important to remind people of. And then the other thing, if I just put on my really optimistic hat here for a second, is that once we get past this noise, and I've been referring to this as noise for a while, whether it's the tariffs, Doge, or whatever, once we get past that, the next thing up on the Trump agenda are tax cuts and deregulation. So remember, when we think about stocks, we don't just think about tomorrow. Like, we knew tariffs were coming for 18 months, possibly even longer, but it's not like this is a surprise to anybody. I mean, it shouldn't be. Trump's been talking about tariffs since, since he left office, or decided to run again. What you're really doing as a market participant is you're looking at least a year out. So what does that mean next year? Well, next year, if we have tax cuts and deregulation starting to hit the market, that's good, right? That's ultimately very good. So we don't want to get too bearish on near-term numbers. We want to basically make sure that we are, taking our time, being patient, adding where things are really silly, and look forward to what I think is ultimately going to be a very good opportunity for economic growth. So quickly running through the strategies on the conservative, global vigilance, really not a lot of material changes. Frankly, this portfolio has been doing great. It benefits from having a lot of fixed income, as you can imagine, and not a lot of stock exposure. So that's been fantastic. Moderate, as I mentioned, we're sitting with like 9% cash, although we're deploying a little bit of it this morning. It's very, it has a decent amount of fixed income exposure, and the equity exposure is in, I would call, areas that are not, directly exposed to tariffs. And as I also said, we're starting to take little, pick at some of the places where Doge has been perhaps misinterpreted. So that's been great. And the other thing we've been doing is, we have 10% commodities, and that's basically gold miners, and uranium. And I'll tell you, the gold trade for us has been incredible. And so one of the things we've been doing is selling our gold position down or trimming it just because it's really vastly outperformed the portfolio. And I think that's something that makes us a little different. And then finally, tilt. So this is our aggressive portfolio. It's 73% equities right now. We've raised a little bit of cash. We have a lot more commodity exposure than in others. And at the end of the day, we're pretty comfortable with this, but and looking to take looking again for opportunities to continue to grow this over time. So let me stop there, and Keith, we can go to questions.
Sorry about that. I accidentally waved my hand at you before. I didn't want you to think I was like, wrapping you up, but great stuff, Jim. Man, there's always so much information that's in there. It looks, however, like you did such a fantastic job that looks like we don't have any questions this go around. So I guess with that, I would just thank everybody for taking time out of your day. Have the great rest of your week, and please let us know how we can help. And we'll see you next month. Thanks, Jim.
Thank you.